While Tesla is recouping its losses after sliding on an earnings miss, my next guest says Tesla is caught between its past and its future and faces some pain ahead. Now, he lowered his price target slightly, but he's maintaining a buy on the stock. So joining me now is George Gianarikas. He's senior analyst at Canaccord Genuity. George, thanks so much for being here today. I guess we'll just start with a brief overview of your thoughts on the quarter. We sort of ran through that they had an earnings miss, but they did report stronger than expected revenue.
They had a great deliveries quarter in the third quarter that basically helped them overcome the first two quarters that were basically terrible. But the real tension here in the market is trying to figure out how Tesla will bridge its current EV-related business to a future that's more focused on robot cars and robot humanoids. And what investors are really trying to understand is what that bridge looks like. Is it going to be a timeout from growth? Or will we continue to see growth over the next several quarters and years? And I thought last night's earnings release had something interesting where Elon Musk essentially said for the first time in a while that the company's going to increase its production capacity, which to us signaled that he actually has some confidence in EV sales growing for the foreseeable future. While at the same time, that long-term growth trajectory with humanoids, there was a little bit of a pause there in terms of how quickly they can scale up production. So we had a little bit of everything. Some good news, I thought, on the EV side, but a little bit of pause on how quickly they could scale that robot army.
That's really interesting because it feels like, at least before we got the results yesterday, whenever we were speaking about Tesla, it was all focused on robo-taxis straight ahead, and that, you know, maybe we're past the growth area for the EV sales. But like you said, deliveries were stronger, and then now maybe they're slowing the robo-taxi, at least to a degree, or they're less bullish there. Can both be true? I mean, can you grow both at the same time?
Well, we think so. Look, the robot cars, the robo-taxis will continue to scale this year and beyond. But our concern about just what that market looks like in the United States is their cost of bringing those to market. Our analysis suggests that it's about $1 plus in terms of cost per mile to the consumer. But if you really want to break through and create an enormous market for robo-taxis, you have to get to something that's less than 75 cents. But for now, it'll be 24 billion miles, which doesn't mean it could be impactful to Tesla's P&L, but not enough to really drive it until 2030 and beyond.
And it is worth reiterating here that you're reiterating your rating and you're lowering the price target, that we are seeing shares sort of recover from those early losses. If you can't see the chart, it's sort of that march higher up and to the right. But I'd love to ask you, George, while we have you, because you have sort of a wide range of coverage and expertise about rare earths. Obviously, the United States, Australia signing this critical minerals agreement, $8.5 billion project pipeline with a $3 billion investment over 6 months. And so we're seeing a lot of stocks in this area rally. What do you make of this agreement between the United States and Australia as they try to source these rare earths from areas that don't involve China, frankly?
Look, our estimate is that we consume about 50,000 tons of rare earth magnets per year in the United States. And if you look at what MP plans, what other companies like we cover, like USA Rare Earths, we still have a large gap to fill. MP plans on building 10,000, USA Rare Earths about 4,800 tons. And if we want to become a self-sustaining market, we need a lot more magnets to build in the United States. And to make that happen, we need oxides, the rocks, essentially, the powders. We need to make the magnets. And so there's a lot of room to run here, and we need help from our partners to make that happen, whether it's Australia, Canada, other markets. And so you'll see a lot of this activity, in our opinion, now and in the future to make sure we can secure a supply chain to build those magnets here.
Do you think that the stocks have moved appropriately, or is this buy rumor, sell news?
Look, our price targets are where they are, but we suspect over time that the market needs to figure out what the cost curve looks like in the United States and in our friendly partners. So if you look at the cost of these materials coming from China, they're at depressed levels. And what we haven't figured out yet as a country and as a West collectively is what that cost curve looks like. In our models, we have assumptions that are a little bit higher than where the current market is in China. But if you listen to what the companies in the sector say, they're trying to send a signal, look, our magnets have to be significantly more expensive than they are from China because we just have a different cost structure here. And eventually the market will figure this out. I mean, no one really knows what that price is today, but I think the stocks reflect this uncertainty as to how this pricing will play out in the U.S. and the West over time.
I see. got a lot to learn, and I got to go back to my periodic table of elements, too, for some of this to get through some of these notes to make sure I have a good understanding of it. George Gianarikas with Canaccord Genuity, thanks for joining us here today on a two-pronged segment.